All right, today we're going to get our hands dirty and look at the blueprint that lets you see a company's real financial story, the three-statement financial model. And look, this isn't just for accountants or Wall Street pros. This is a super powerful tool for anyone who wants to understand the true health of a business. So let's just dive right in.
So let me start with a question, a classic business puzzle. You see the headlines, right? Record profits. Everyone's high-fiving. And then, out of nowhere, the company is out of cash and can't pay its people. How does that happen? Well, it happens more often than you'd think, and it all comes down to a fundamental truth. Profit on paper is absolutely not the same thing as cash in the bank.
And this slide right here gets to the very heart of that puzzle. On one side, you've got profit. This is based on something called accrual accounting. It basically means you record revenue when you earn it, not when the cash actually hits your account. So think about it. If you sell something but let your customer pay you in 30 days, you've earned the profit, but you don't have the cash, right? Then on the other side, you've got actual cash, the cold, hard cash you need to pay salaries and keep the lights on. This is why understanding the difference is so crucial.
Okay, so here's our game plan. We're going to meet the three core parts of what I like to call our financial machine. We'll see how they're all wired together, track some of the key moving parts, tackle let's call it the ultimate power loop. And then, finally, we'll see why this machine is one of the most powerful tools out there for financial analysis.
You know, the best way to think about the three financial statements isn't as separate documents, but as one single, integrated machine. Every part has its own job, but, and this is the key, none of them can work right without the others. So let's meet these core components.
First up, we've got the income statement. I want you to think of this as the engine of our machine. It tells you how powerful the business is, how much horsepower it's generating over a set period, like a quarter or a whole year. It's basically subtracting all your costs from all your revenues to tell you one simple thing. Are we actually making a profit?
Next up is the balance sheet, and this is the chassis or the frame of our machine. Now, unlike the engine, which measures performance over time, the chassis is just a snapshot, a picture taken at one specific moment. It shows you the company's entire structure, everything it owns, those are its assets, and everything it owes, those are its liabilities. And it has to follow one simple, unbreakable law. Assets must always equal liabilities plus equity, always.
And last but not least, the cash flow statement. This is the fuel system. I mean, an engine and a chassis are pretty useless without fuel, right? This statement tracks the real cash, the lifeblood of the company, moving in and out. It's the thing that bridges the gap between the engine's paper profit and the actual cash in the tank. It shows if the machine really has the fuel to keep running.
So we've met our three main components: the engine, the chassis, the fuel system. Now, let's see how they're all wired together. And the most important connection of all starts with just one single number: net income.
So follow me here. The journey of net income is really the main circuit that powers this whole model. First, it's born right at the bottom of the income statement. It's that famous bottom line. From there, it travels over and becomes the very first line item on the cash flow statement. And its journey ends on the balance sheet, where it flows into an account called retained earnings, which makes the company's overall equity go up. It's a beautiful little trip.
This table really just maps out that core connection we just talked about. You see net income flowing from the income statement to both the cash flow statement and the balance sheet. But, take a look at that third line. If a company pays out cash to its shareholders, what we call dividends, that cash leaves through the cash flow statement, and it also reduces those retained earnings on the balance sheet. See? It's a perfect self-contained loop.
All right, so the main wires are connected. Now let's look at some of the other really important moving parts of our machine. We're going to focus on two big areas: the company's long-term assets, what we call property, plant, and equipment, or PP&E for short, and the everyday cash that gets tied up in running the business, which is called working capital.
So let's start with PP&E, property, plant, and equipment. These are the big physical things: factories, computers, machinery. The value of these things on the balance sheet isn't static. It's always changing. And it changes based on this simple formula. You take what it was worth last year, you add any cash you spent on new stuff, that's called capital expenditures or CapEx, and you subtract depreciation, which is that non-cash expense from the income statement. This is what keeps the balance sheet perfectly in sync year after year.
Okay, now for a concept that I'm telling you trips up so many people when they're first learning this: working capital. It feels totally backwards at first. You'd think that having more assets, like a big warehouse full of inventory, is a great thing, right? But from a pure cash perspective, how did you get that inventory? Well, you spend cash to buy it.
So more inventory today means less cash in the bank today.
So here's the rule of thumb. An increase in an operating asset, like inventory or accounts receivable, which is money customers owe you, is a use of your cash. Your cash goes down. But on the flip side, an increase in an operating liability, like accounts payable, which is money you owe your suppliers, that actually acts as a temporary source of cash because you're holding on to it for a little longer. Getting these adjustments right is absolutely essential to get from that paper profit to real, actual cash.
All right, we've connected the core parts, we've tracked the moving pieces. Now it's time to tackle the model's final boss. This is the circular reference that can happen when you bring debt into the picture. It can get a little loopy.
Yeah, this is the ultimate chicken and egg problem in financial modeling. It's what's known as a circular reference. It's when you have a calculation that depends on a result that it itself helps to create. It's like trying to figure out the interest you owe on a loan when the size of that loan might change depending on how much cash you have, which in turn depends on the interest you owe. See the problem?
Okay, so here's how that loop works. Your interest expense on the income statement depends on your debt balance, but your debt balance depends on your cash flow, because you might need to borrow more if you're short on cash. Well, your cash flow depends on your net income, and your net income depends on, you guessed it, your interest expense. And boom, we're right back where we started. Now, in the real world, modelers often break this loop by just using last year's debt balance to calculate this year's interest. It's a common shortcut.
We have built this incredibly complex, interconnected machine. I know, it's a lot. So now let's talk about the big payoff. Why on earth do we go through all this trouble? Because a properly working model is the key to unlocking some seriously powerful strategic insights.
Here it is, the final, critical connection that makes the whole thing just click. After you've calculated all your cash flows from operations, investing, and financing, you get one final number, the ending cash balance. That one number then flows directly back to the balance sheet and becomes your cash line item for the new period. That closes the entire loop.
And how do you know? How do you know for sure that you've done everything correctly? This beautiful number right here, 0. You do a simple check, assets minus liabilities minus equity. If that formula equals 0, it means every wire is connected, every moving part is tracked, and your financial machine is perfectly balanced and mechanically sound. It works.
Now, with a balanced model, you have this incredibly powerful dashboard for making decisions. You can calculate what's called free cash flow to see what cash is really available. You can run all sorts of what-if scenarios, like what happens if sales drop 20%? Can we survive? You can test the company's financial resilience, make way smarter investment decisions, and ultimately, you could even figure out what the entire company is worth.
And look, don't just take my word for it. This quote really hits the nail on the head. Building one of these models isn't just some boring accounting exercise. It is the absolute cornerstone, the foundation for any kind of serious corporate finance or valuation work. It's how you go from just reading the numbers to truly understanding the story they're telling.
So, you've seen the whole machine now. The engine, the chassis, the fuel system, all working together in harmony. I'm going to leave you with a question to chew on. If you could only inspect one single part of this entire machine to get a quick read on a company's health, which part would you choose and why? The answer to that says a lot about what you value as an analyst.